October 2025, China exported 660 tons of silver in a single month, the highest monthly volume on record according to multiple commodity tracking services. And here's what nobody saw coming. That wasn't China losing control. That was China executing a perfect exit. Because 3 months later, silver hit $69.44 per ounce, an all-time record high, a 138% gain for the year. And retail investors, who thought they were early to the squeeze, are now holding at the peak, while the smart money that dumped 660 tons in October is sitting in cash. This is the story of how a coordinated supply release broke a supply squeeze that was supposed to send silver to triple digits, how retail FOMO at $60 to $65 provided the exit liquidity that institutional money needed, and why the narrative everyone believed, supply deficit plus industrial demand equals unstoppable rally, missed the most important variable: someone with 660 tons willing to sell at precisely the right moment. In the next 20 minutes, I'm going to show you exactly what happened between October and December 2025. How China's record export solved a London market crisis that was driving prices parabolic. Why retail investors piled into silver ETFs at all-time highs. What the inventory data reveals about who got trapped. And why December 2025 might be remembered as the top, not the beginning. Before we talk about the trap, you need to understand the squeeze. Because the squeeze was real, the fundamentals were legitimate, and that's exactly what made it the perfect setup. Silver entered 2025 in its fifth consecutive year of structural deficit, according to the Silver Institute. Mine production stagnant at roughly 813 million ounces annually. Recycling unable to close the gap. Industrial demand exploding from solar panels, electric vehicles, and data centers. But the math was undeniable. More silver consumed than produced, and the physical market confirmed it. Shanghai Futures Exchange inventories collapsed below 500 tons in November, the lowest level in a decade. London Metal Exchange vaults had been draining for years. Physical silver became scarce, not just expensive, actually hard to source. Lease rates, the cost to borrow silver for immediate delivery, spiked to 200% annualized in October. When you're paying 200% interest to borrow metal overnight, that's not normal market stress. That's panic. Retail saw this. The silver community, Wall Street Silver on Reddit, precious metals forums, stacking channels. They watched inventories collapsing. They saw premiums exploding. American Silver Eagles selling for $8 to $10 over spot. Generic rounds $5 to $6 over. And they did what the narrative told them to do. They bought. Because every data point screamed the same story. Supply squeeze plus monetary debasement plus industrial demand equals silver going to $100, maybe higher. But here's what retail missed. October 2025, while everyone was focused on price action and technical breakouts, China exported 660 tons of silver. According to customs data, confirmed by multiple commodity analysts, this represented the highest single-month export volume on record. Not spread across the year, not gradual liquidation, 660 tons in 4 weeks. And the destination wasn't random. London, straight into LBMA warehouses. Let me show you why this matters. The London market was squeezing hard. Industrial users needed physical metal. Investment demand was surging, but available supply in London vaults had been declining for years. This created the conditions for a classic short squeeze. Buyers willing to pay any price, sellers unable or unwilling to deliver, prices spiraling upward. And then 660 tons arrived from China. Here's the mechanism. Shanghai inventories fell below 500 tons, not because China ran out of silver. China produces roughly 3,300 metric tons annually according to U.S. Geological Survey data. They weren't running out. They were reallocating, moving silver from domestic exchanges, where it was doing nothing, to international markets, where it could be sold at premium prices into peak demand. Strategic inventory management at its finest. And the timing wasn't coincidental. October 2025, silver was trading in the low to mid $50 range. The rally had momentum. The squeeze narrative was building. But prices hadn't gone parabolic yet. This is the perfect window for a large holder to liquidate. High enough to maximize profit. Not so high that the market can't absorb supply. China saw that window and executed. But there's a deeper game here. China didn't just sell silver, they solved multiple problems simultaneously. First, they monetized inventory at near peak prices. 660 tons at $50 to $55 per ounce generates roughly $1 billion to $1.2 billion. Not insignificant revenue. Second, they eased domestic supply constraints. Chinese solar manufacturing, which consumes massive quantities of silver for photovoltaic panels, was facing input shortages. By exporting to London and relieving international pressure, China could redirect remaining domestic supply to local industry. Third, and this is where strategy becomes evident, China prepared for January 2026 export restrictions. Starting January 1st, 2026, China implemented licensing requirements for silver exports. According to announcements from the Ministry of Commerce, only firms producing at least 80 tons annually would qualify for licenses. This effectively shut out smaller exporters and gave Beijing control over future supply flows. But before those restrictions took effect, China flooded the market, dumped inventory at profitable prices, locked in revenue, then restricted future supply to support prices later. This is textbook resource playbook. Sell high before you announce restrictions. Let prices correct from the flood of supply, then restrict exports and watch prices recover with you holding less inventory but more control. Classic strategic positioning. And retail walked right into it. While China was executing this plan in October, what was retail doing? Buying. Silver hit $57 in November, and the silver bugs celebrated the breakout. $64 in early December, and they called it confirmation. $69.44 on December 21st and 22nd, and they declared victory. The squeeze was working. Triple-digit silver was inevitable, except it wasn't. Look at the ETF data. iShares Silver Trust, symbol SLV, the largest silver ETF, saw inflows of 15.7 million ounces in November 2025. According to published reports, this was the highest monthly inflow since July, institutional and retail money pouring in. But here's the critical question. Were those inflows smart money or dumb money? Were institutions accumulating, or were they distributing to retail? The answer is in the timing. November inflows came after silver had already risen from $30 in January to $57 by November. That's a 90% gain. Smart money accumulates early, dumb money chases momentum, and 15.7 million ounces flowing into SLV at $50 to $60, that's late cycle buying. That's retail and momentum funds chasing performance. That's the exit liquidity. Compare this to what happened in early 2025. In the first half of the year, silver ETFs saw roughly 95 million ounces of inflows according to industry estimates. But those inflows came when silver was $30 to $40. Early buyers at reasonable prices. The November spike, 15.7 million ounces in 1 month. That's panic buying. Fear of missing out. Exactly the behavior that marks tops, not beginnings. And the sentiment data confirmed it. Reddit forums full of posts about silver going to $100. YouTube videos declaring the squeeze unstoppable. Bullish sentiment surveys showing over 80% bulls. Historically, when sentiment reaches these extremes, tops follow within weeks. Not because sentiment causes reversals, but because extreme bullishness means everyone who's going to buy already bought. There's no one left. And when buying exhausts, price falls. The gold-silver ratio also flashed warnings. In October, the ratio was roughly 72 to 1. By December, it compressed to 64 to 1. This rapid compression, silver outperforming gold dramatically, is typical of late-cycle speculative moves. Silver is more volatile than gold. It lags on the way up, but leads on the way down. When the ratio compresses quickly, it signals excessive speculation in silver, and that excess always corrects. Now let's talk about what happened in London, because this is where China's 660-ton export had its maximum impact. Before October, London vaults were critically low on deliverable silver. Industrial users were scrambling, lease rates at 200%. The market was in backwardation, meaning immediate delivery cost more than future delivery, classic squeeze conditions. And then 660 tons arrived. That's roughly 21 million ounces. In a market experiencing a fifth consecutive year of deficit, projected at roughly 215 million ounces, according to the Silver Institute, adding 21 million ounces in one delivery is significant. It's approximately 10% of the annual deficit arriving in 4 weeks. And it broke the squeeze. Not permanently. The structural deficit remains. But the immediate crisis, the one driving prices up daily, got resolved by Chinese supply. Lease rates normalized. Backwardation eased. Physical premiums compressed. The narrative that drove silver from $30 to $69, acute physical scarcity, was temporarily solved. Not because fundamentals changed, because someone with supply decided to sell at the right moment. And retail, focused on price going up, missed the distribution signal entirely. Here's the pattern you need to recognize. Phase 1, fundamentals tighten. Real supply deficit emerges. Prices start rising. Early buyers profit. Phase 2, momentum builds. Retail notices, media covers it, FOMO intensifies. Late buyers pile in at elevated prices. Phase 3, the trap springs. The entity holding supply, in this case China, dumps inventory into peak demand. Prices spike one final time, creating the illusion of continuation. Then, supply hits and the squeeze breaks. This exact sequence played out with the Hunt brothers in 1980. They accumulated 200 million ounces. Drove silver to $49. Then the market changed rules, forced liquidation, and silver crashed to $10. The Hunts lost billions. Everyone who bought above 40 got crushed. The only winners were those who sold at the top. In 2025, China played that role. Now, let's talk about who's trapped. retail investors who bought silver above $60 thinking it was going to 100, ETF holders who piled into SLV in November and December. Those 15.7 million ounces of November inflows bought at $50 to $60. That's not smart money. Smart money was the 660-ton Chinese export in October. That was distribution. Institutional profit taking at $50 to $55. The retail inflows at $60 to $65. That was accumulation by the wrong people at the wrong time. And the mining stock insiders confirmed this. Throughout Q4 2025, executives at major silver miners sold shares. Not small amounts. Significant positions. When insiders who run the companies sell while silver hits all-time highs, they're signaling something. They know their cost structures, they know what's sustainable, they know when prices have overshot, and they sold. Retail bought the miners thinking leverage to silver prices would amplify gains. Instead, they bought at the cycle top. Look at what happened after December 22nd. Silver hit $69.44. Then what? Consolidation. Pullback. By late December, silver traded back down to the high 50s to low 60s. Normal consolidation, they said. Year-end profit taking, they said. But here's the reality. The top was in, not because fundamentals changed, because the 660-ton Chinese dump already solved the supply crisis that was driving the squeeze. And here's what comes next. Silver could consolidate between $50 and $70 for the next year, possibly longer. The structural deficit remains. New mines take 5 to 10 years to develop. Industrial demand keeps growing. All of this supports prices above historical averages. But short term, the squeeze is broken. China's 660 tons restored enough supply to ease immediate tightness. Lease rates normalized. Premiums compressed. The panic bid disappeared. Retail holding above 60 faces a painful choice. Hold through potentially extended consolidation, hoping for new highs, or accept losses and move on. Most will hold. That's what retail always does. They bought the story, supply deficit, industrial demand, monetary debasement, and they're not selling at 57 after buying at 65. They'll wait. And wait. And maybe silver eventually breaks 70 and runs to 100, but that could take years. An opportunity cost is real. The smart play, the one institutions made, was selling into strength in Q4, taking profits at $50 to $65 after riding from 30, rotating into cash or other assets, waiting for the next setup. Because commodities don't go up forever. They spike, they consolidate, they correct, then they spike again. Retail wants to hold through entire cycles. Institutions sell the spike and buy the dip. Let me show you a historical precedent. 2011, silver hit $49 in April, then crashed to 26 by September. 47% decline in 5 months. It didn't break 40 again until 2024, 13 years. Everyone who bought above 40 in 2011 spent over a decade underwater. Some sold at losses, some held and finally broke even in 2024. Either way, opportunity cost destroyed them. 1980, silver hit $49 in January, then crashed to 10 by March, 80% decline in 8 weeks. It didn't reach 40 again until 2011, 31 years, an entire generation. People who bought at 40 in 1980 were retired before they saw break even. This is the risk retail ignores. They focus on upside, triple-digit silver, life-changing wealth, but they don't consider downside, multi-year consolidation, decades underwater, capital trapped while other assets perform. The 2095 setup has identical characteristics. Parabolic move from $30 to $69. Record high. Retail FOMO at the peak, and a major holder, China, dumping 660 tons into strength. Every historical precedent says this ends badly for late buyers. Maybe not immediately. Silver could stay elevated for months, but the top is likely in. And those who bought at 60 to 69 will spend years wishing they'd sold. Here's what retail should have seen. Volume. In October, when China exported 660 tons, futures volume spiked. Not from buyers, from sellers. Large block trades, institutional size. This was distribution, smart money liquidating into retail demand. But retail, focused on price-breaking resistance, missed the volume signature. They saw breakouts and bought. They should have seen distribution and sold. Sentiment at extremes. Silver sentiment surveys in November showed over 80% bulls. Historically, when bullishness exceeds 75%, tops follow within weeks. Not always, but usually. Because extreme sentiment means positioning is crowded. Everyone's already long. There's no buying power left. And when marginal buying disappears, price falls. The gold-silver ratio compression, from 72 to 1 in October to 64 to 1 in December. This rapid move typically marks speculative excess in silver. When silver massively outperforms gold in a short period, it's usually a late cycle phenomenon. Gold provides the foundation, silver provides the speculation, and when speculation peaks, corrections follow, technical breakouts on extreme volume. Silver broke above $64, the 2011 high, in December. This attracted massive attention. Everyone waiting for confirmation piled in. But late-stage breakouts often fail, especially when accompanied by parabolic price action and record volume. The December breakout above 64 was a bull trap. It sucked in final buyers right before the turn. Every indicator, volume, sentiment, ratio dynamics, technicals, pointed to exhaustion. But retail ignored them because the narrative was so compelling. China export restrictions coming January 2026. Industrial demand unstoppable. Structural deficit continuing. All true, but all priced in by the time retail understood the story. Markets discount the future. When retail figures out the thesis, the move is over. So here's the takeaway. China's 660-ton silver export in October 2025 wasn't random. It was strategic liquidation of inventory into a supply-squeezed market at near-peak prices. It solved China's domestic industrial needs, generated substantial revenue, and positioned China to implement export restrictions in January 2026 from a position of reduced inventory but maximum control. The 660 tons broke the London squeeze, eased physical tightness, and allowed prices to run one final time to $69 before consolidating. Retail focused on narrative and momentum missed the distribution. They bought into the final spike at $60 to $65. They provided exit liquidity for smart money that sold in October and November. And now they're trapped at all-time highs while the market consolidates or corrects. This pattern repeats every commodity cycle. Early buyers profit. Late buyers get crushed. The holder with supply, whether OPEC with oil or China with silver, always controls the top. They sell into strength. They cap rallies. And retail, believing this time is different, walks into the same trap every time. The 660-ton dump was the signal. The market gave it to you. Massive supply injection at peak prices during maximum narrative intensity. If you didn't see it, if you bought silver at 60 to 69 thinking it was going to 100, you just learned an expensive lesson about market structure. The fundamentals don't matter when someone with 660 tons decides to sell. The narrative doesn't matter when physical supply solves the squeeze. What matters is positioning. And in Q4 2025, retail was positioned perfectly wrong. If this showed you a pattern you didn't recognize, if you understand now that China's October export was the distribution signal, then you're starting to see how commodity markets actually function, not through simple supply and demand, through strategic inventory management by nation states with resources and timing. Subscribe, because over the next year, we'll track how this plays out. And whether silver breaks 70 again or consolidates for years, whether retail capitulates or holds through pain, the pattern is clear. The trap was sprung. December 2025 might be remembered not as the beginning of the silver supercycle, but as the top. And the question is whether you saw it in time or learned the hard way.